What's good, everyone? Welcome to Street Alerts. I'm your host, Chris Correa, and this is the market breakdown for Friday, November 12th, 2021. Now, if you're new to the channel, I want to say thank you because this channel would not be what it is without you guys following, subscribing, and tuning in. Now, every day, the market is giving us signals, opportunities. There's news in the market. There is potential trades. And every day, what I try to do is bring those latest movements that's going on in Wall Street to you guys via this channel here, where I talk about stocks, I talk about sector movements, and basically everything that's on my radar that I'm looking at, and hopefully alert you guys on what I'm seeing in the market. I used to trade with one of the largest financial banks in the world, but I'm no longer a financial professional. I trade on my own. I trade my own portfolio. I consult privately for clients who want to learn how to trade and how to invest the way that banks do. So this channel really is not financial advice. Okay, I'm not here to tell you what to buy or what to sell. I'm here to help educate you the best way that I can and give you my take on the markets and share with you guys what stocks that I am watching and what I'm looking at. That being said, let's go ahead and talk about the markets. Now, for the last few weeks, we've been closely monitoring the 10-year yield. Okay, yesterday the bond market was closed, and I don't even know why the stock market even opens when the bond market is closed. That's like opening up a car wash, and the water is turned off. Okay, they feed off of each other. It just doesn't make any sense to have one market open with the other closed. But whatever. Okay, the thing is that we have a 10-year yield that isn't moving. Okay, it's in no man's land. It's hanging out and it's really not doing anything. The yields aren't high enough to move the banks higher, and I'd probably say about 1.6 at least, but they're also not low enough to get big tech moving, which I would say is maybe 1.45, somewhere around that level. We're stuck in the middle. So let's go ahead and look at the charts. The first one I want to show you guys is this one right here. Okay, this is the growth stocks, and if you look here, you see that they are pretty much not doing anything. All right, they're kind of on a pause. You got XLK, okay, pretty much is the same thing. Okay, they ran up and now pretty much at a pause. You see them kind of going sideways for the last week. The banks, the XLF here, okay, they also are moving sideways. The SMH, okay, let's look at the semis. And again, you see the same kind of activity going on where you're getting this sideways movement, okay? Now, do you guys see what's going on here? The yields are right in the center, okay? And they're not in any range to favor a particular side right now. The banks aren't moving higher because, again, the yields aren't favoring them, and tech isn't moving because those lower rates are just not there. If you look at the XLF, okay, you're seeing this sideways movement going on. If we switch over to the XLY and look at the discretionaries, these have been, again, doing well, but now what you're getting is pullbacks, okay? XLE, energy, same thing here. You're getting sideways action, okay, going on in the stocks, okay? Now, the thing I want you guys to remember here, guys, is that the high yields loves banks, industrials, discretionary stocks. Let's compare. I'm going to pull up Microsoft here, okay? Microsoft pretty much is on pause. Let's go over to a financial. HSBC. We all are familiar with that bank. This one is pulling back, okay? Facebook. This one's not doing well at all, okay? So you got these stocks right here, which are basically rolling over. Let's continue on. Let's look at the banks. Let's look at JP Morgan, okay? Same thing. It's starting to kind of roll over on you, all right? Morgan Stanley, same thing. You're getting some rollover here, okay? Amazon holding up a little bit better, but again, you're starting to get a top out here, okay? These pullbacks. Now, what about oil? pause button. Somebody just hit the pause button on this thing. Okay, this thing is ran up and then went on pause and has moved sideways. Let's look at big tech, the XLK. Okay, ran up and now it's basically kind of just moving sideways. It's not continuing here. Okay, the semis again is on pause mode. Ran up and somebody just hit the pause button. Now we got the Cerveza related stocks, which you guys know what I'm talking about when I say Cerveza stocks, all right? Hopefully you know what I'm talking about. NCLH, oh, wrong one. NCLH, the cruise lines. Look at this. Do you guys see that? JetBlue, look at that. MGM. You guys see this? Pullback city. That's what we're in. Pullback city with these Cerveza related stocks. So the question right now is, what is working, guys? And it's very important to pay attention to what I think is pretty significant in the market right now. I've been talking about inflation on my channel for a good minute now, a hot minute, okay? Now, these guys in Congress don't seem to have any care in the world for inflation, and instead they're doing a damn good job at creating it. This is going to have a financial, economic impact that's going to make life difficult for everyone, especially for the poor and the middle class who they're trying to rally and save. It's not going to do them any favors, but it's not going to do everybody any favors. Inflation is going to eat our paychecks for lunch and dinner, pun intended, okay? And the buying power in the dollar is going to shrivel up as we start seeing the prices go up everywhere as a result of all the printing that they're doing. Again, I've been talking about this for a good minute on my channel. So it goes back to the question, what is working? Let's look at what's working. GOLD, gold. You guys see this? A good majority of the market just basically pulled back and went on pause. Okay, I showed you a lot of those charts that we just pulled up. And you got gold out here flexing, moving up. Inflation is finally starting to work its way into the market. That's why you need to watch gold. Like every day, guys. These yields aren't working for the value stocks. These yields are not working for the growth stocks. But the inflation is working for the metals. Gold, GDX, GDXJ, AU, even AUY. Watch them, because I think these guys are getting ready to make some moves. So watch gold. Another thing I think we should all watch is the small mid-cap banks. There's a few stocks that have shown some relative strength, and I'm going to probably add maybe one or two of those stocks in my portfolio. Now, whenever I buy or sell a position, I like to let you guys know that. I want to actually pause for a minute and put it front and center that I have no problem at all talking about stocks that I'm thinking about buying or have taken a position in. I know some tubers and channels have a different take on that. That's fine, but I don't. I'm putting it front and center that the stocks that I talk about are stocks that I am looking at or maybe even involved in. And again, this channel is not financial advice telling you what to buy or sell. What to buy and sell is your own business, guys. My job is to try to bring the education to you so that you guys can see the matrix and what's playing out in the streets. These small caps that I'm looking at, these small cap banks that I've been eyeing. Here's the first one, HLI. This stock consolidating right here. So we may get a breakout here. And that's what I'm looking at. Here's another one, FNF. Ran up and it's pretty much on pause. Okay. And here's one more also, KRE. Okay. This is another one that's basically just kind of consolidating. Those are three stocks that right now I like in the small mid cap bank sector. Now, as far as tech goes, there's the only mover here seems to be Datadog, D-Dog, okay? If you've been following my channel, I've turned my followers to Datadog like 5 to 6 weeks ago, and it's just been on a freaking tear. Xilinx, this is another tech stock that is just freaking on a tear, okay? The market went down this week and tech was dropping all over the place, but these stocks were actually up. That's what I call relative strength, and that's what I'm talking about with these stocks. So bottom line, the gist is this, guys. These stocks may have more gas in the gas tank. So we'll see. I'm going to continue to watch them and see how they play out. Discretionary stocks, BBY, Best Buy. This is one of my favorite, okay? And look at how nice, look at how beautiful this thing is moving, okay? Even Ford, beautiful movement on Ford, okay? Another one with relative strength. The big box stores, though, they've been kind of falling. They haven't been doing so good. But Ford and BBY, they look good. So listen, guys, when you take and you look at a market like this, I always try to teach my subscribers, my followers, the people hanging out with me on Twitch, to take profits. Okay, when stocks run up like this, it's never a bad idea, and something again that I try to teach people how to do after a stock has ran heavy to the upside is to take profits. It's never a bad idea to take some of those gains off of the table. Never hurts to do that, and this might be a good time to do that. Now, moving away from stocks to the market in general, here's a little history lesson for you guys, and it's very important. Those who know this history have a higher likelihood of not losing money when the market tanks. So as the saying goes, those who don't know history are doomed to repeat it. This is why this lesson right here is very important, okay? Listen up. After the market crashed in 2008, but not only in 2008, but even going back to every crash since 29, the Matrix would modify the monetary policy to build the economy via business investment. They would focus heavily on productivity, focusing on growth. This really focused on what could be done to produce and to get the companies in production mode. That was a focus. In 2008, though, this didn't happen when we had a crash. Okay, they switched programs. They went from putting money into business investment to an inflationary model focusing the monetary policy primarily on printing and spending money. Typical progressive monetary policy. So instead of going into a recession where businesses fold, go bust, and they go out of business and get replaced with better companies, and also, guys, what this does is actually it clears out the sludge in the system. Now, economically, this isn't a pleasurable event in the beginning, okay? Because you get layoffs and all of that. You get people who lose money if the stock pretty much, if the company goes out of business, the stock goes down to zero. So in the beginning, the recession is hard times, temporarily. But once those bad companies have been flushed out, you get a strong economy because now better companies are running things. The corporations that were weak and they were failing are replaced with newer, fresh companies that are better and stronger. But again, in 2008, they switched programs. They decided not to do this. Instead of clearing out all of the bad businesses through a recession and letting them go away, we decided to forego all of that and instead turn on the money printers, a monetary policy of printing and spending money. And all that does is put the economy on government dependency. It's life support to the markets. And instead of, again, the bad companies going bust and being flushed out, they're kept alive through QE. And the worst thing is that this engages in massive money printing, which affects the entire society. So instead of stocks going up because companies are reinvesting into new equipment and focusing on productivity to get the stocks moving, instead of doing that, they put that aside and move their stocks higher by printing more money and putting that money into the market. It bypasses productivity. That's called quantitative easing, aka QE. And that's what we've been doing since 2008. You got $41 trillion that's been printed. And in the last 18 months, I think it was like $14 trillion. And that's just what they're reporting to us. Who knows what the real number is? The question is, well, why are they doing this? It's very simple. To keep the interest rates at zero, that's number one. To create inflation, that's number two. And to push the stock market higher, that's number three. And this is great for the rich and the wealthy and those of us who are in the stock market. But what about Main Street? People who don't participate in the market gains, the normies. The normies get killed because there isn't productivity, which this affects employment levels. That's phase one. Phase two is when they start getting hit with wages that aren't increasing while the cost of living is going up because of inflation. And at some point, it gets bad enough where our owners finally realize they got to raise rates because inflation is completely out of control. And that's usually when you have the normies deciding what they're not going to pay. Okay, what bills are going to be paid and what bills they're going to default on because they just can't pay it. But until Main Street goes through that experience, they're going to continue to push the market higher with more printing and QE. So make no mistake, they're going to continue to run the market up until finally the general public just can't take the heat. But until that point, this is where we're at. The market is going higher, okay? They're going to continue to ignore inflation, and we're going to continue to feel inflation in our prices until finally, like I said, when they see that the people can't take the inflation anymore. They can't take the heat anymore, okay? They can't actually pay the bills no more. That's when things are going to get ugly. And I think we're getting close to that happening. When it does happen, all of this easy money printing, it's going to stop. But economically, this is where we're at and this is where we stand. So guys, this is not doom and gloom. Don't get it twisted, okay? This is a time to learn. This is a time to educate ourselves on what's going on. We need to watch. We need to listen, okay? And again, my job here, the whole purpose of this channel is to help you stay out of the traps and position yourself correctly. This is about education, okay? People are really getting screwed. But my followers, you guys, we all have an opportunity to learn how the market works and reap the rewards from that education. The market is moving higher right now, but at some point, this economic policy that they're pushing right now, it's going to rear its ugly head. And when that happens, it's going to affect the entire markets as a whole. And it's going to be ugly. But until then, let's keep our eyes on the charts and let's stay ready. Let's educate ourselves. And let's see what's going on. Now, if you enjoyed this post, do me a favor, guys, click on the subscribe button, okay? Come and hang out with me on Twitch. I live stream every day. I trade the markets and I live stream my trading every day on Twitch. You can see my schedule on Twitch. And I'm also going to be live streaming here on YouTube, okay? This may change. But again, subscribe, okay, so I can keep you guys updated and let you guys know what stocks am I looking at, what am I looking at, you know, in terms of sectors and the market and all of that stuff. You know, that's my job here. I want to help you guys. I want to share my knowledge and hopefully, again, number one, so that we don't lose money and that we're aware of everything that's going on, okay? So until then, guys, you all take care and remember, the world is what you make of it. And always, always, always keep your eyes on the charts. Peace out, guys. I'll catch you in the next video.